Apple is one of the most incredible businesses of our generation, the largest business on the planet, and it's performing great. All is well, right? Or is it creating more risk in the stock market and for you? I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so I'm an Apple geek. I love Apple products. They just work. They're just easy, and they're sleek and cool, and I just love what they've done and how they've influenced the space. And now, are there challenges? Yes, all that sort of stuff. But let's talk about the stock. The stock was the first company to $1 trillion, I believe, in market cap, and right now it's close to $3 trillion, depending on when you're watching this. At the time I'm recording, it's up nearly 30% a year. It's basically put the stock market, along with a few other big names, on its back and carried it higher despite really poor market breadth. It takes up 7% in and of itself, 7% of the S&P 500. And so all is well, right? I mean, things are going well for Apple, right? Or is there something to be worried about because it takes up such a large amount of the actual index? I would argue there are a few things to worry about. Let's dig in. So yes, the price has absolutely soared over the last couple of years. And yes, they actually grew during the pandemic. Their profit margin was fantastic. Their revenue was up during the pandemic while everything was shutting down. And I'm assuming there's a video back there where I predicted that basically when the government shut everything down and started doing stimulus dollars, I said basically just give the money to Apple because everyone's just going to use this money to buy gadgets and stuff like that, stuck at home and whatever. And so the stock price is way up over the past few years. I mean, take a look at these charts. But here's my concern, and I talk about this ratio a lot. The price to earnings ratio is also up significantly. So what that means is while the stock price has grown dramatically and the market cap of the company is now, nearly $3 trillion and it's 7% of the S&P 500, that means all of that run up means we are having to pay a higher price for $1 worth of earnings from Apple. Yes, their earnings are fantastic, okay, and they've been growing. However, the price that you and I are agreeing to pay when we buy the stock for those earnings is higher. So part of the reason why the market cap is nearly $3 trillion and it takes up 7% of the S&P 500 isn't just because, well, the fundamentals are all the same, it's just gotten better. No, you and I are actually paying more for $1 worth of earnings than we had to in the past. And guys, that is cyclical. That is bubble and burst. And so to me, there is higher risk right now simply because the PE ratio from Apple has been trending higher and is higher today. Talked about this one, take a look at these charts. I talked about price to sales the other day. So revenue, sales, minus all your expenses, so paying employees and rent and research and development, creating new products, that sort of stuff. So revenue, sales, minus expenses gets you to your earnings or your profits. So that was that first concern, that the price that we're paying, having to pay for the stock compared to those earnings, revenue minus expenses, is inflated. It's high, okay? But what about price to sales? Because there's really no way to manipulate sales. You can manipulate profit by categorizing some expenses here and depreciating certain things and whatever. There's a little creativity you can apply there. You don't want to get too creative like a lot of firms did back in the tech bubble. But price to sales is price to sales. Like how much revenue did you have and how much price is the stock compared to those sales? Also trending higher, alarmingly higher actually. So there again, we're all pleased with how Apple has performed up to this point. It's nearly $3 trillion. It takes up a large amount of the typical large cap or US fund. It's it's 7% of the S&P 500. A lot of that has come from we're just having to pay more for their stock for a dollar's worth of sales, for the sales that they're receiving today. To me, that's creating a greater risk in our dependence in the markets and everything, dependence on Apple's performance when we're simply just having to pay more for what we were already getting. And then an interesting phenomenon sort of connected to each of those things, okay? Earnings have been growing. I've already stated that, but we have Apple has just routinely had this issue with what do they do with cash? What do they do with cash? I'm not sure they're going to be a trailblazing company. Some of you that are really big into the tech space, you would say Apple hasn't been a trailblazing company since the iPad and the iPhone. I sort of know that they want to test things as Jim Collins would say, fire bullets, not cannonballs. They want to test things, see the market before they really invade a space. So they've got a lot of cash because the company has done fantastic. And so what do they do with this cash? Well, one of the trends has been they buy back a bunch of their stock. And could that be inflating the stock price as well? And if they weren't buying back their own stock, or if they slowed down the amount in which they're buying back their own stock, that would lower the demand for the stock and potentially not have the price inflate as quickly as it has, or not go up as quickly as it has, again, making it such a large percentage of the S&P 500 and typically large cap fund. So is that another reason we should be concerned that the stock price has risen partially on the back by the company just buying back their own shares as opposed to investor demand for new shares of Apple? So to me, I think Apple's a fantastic company. If I were to just survey the world and say, hey, what's the best company out there? I mean, it's Apple or Amazon, right? And so it's right there. They deserve all of that accolade, and I would expect that they'll continue to be a fantastic company in the future as long as their leadership stays intact and is wise and all that sort of stuff. However, I am growing in my concern with how much reliance there is on Apple stock performance for the overall market to do well. And when you look at some of these underlying factors, the PE ratio growing, the price to sales ratio growing, so both of those meaning the price that we're having to pay for the same thing is now higher. I know that ebbs and flows, and it seems like we're on the high end right now. And when you look at the trend of the company buying back shares and what that does to the stock price, I do get a little concerned. Obviously, I'm going to recommend that you stay diversified. And right now, if you own individual stocks and you're buying Apple, I mean, just be aware of these risks. For me, I would tell you be diversified and make sure that your investment approach is connected to your overall financial plan. You're not taking more risk than you need to. You're not relying on Apple to continue to have a higher price to sales and even a higher price to earnings in order for you to reach your financial goals. I wouldn't do that. Make sure you're diversified. Work with your CFP on that investment strategy, making sure it fits within your financial plan. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.